Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. In this video, I'm going to discuss about the accounting standard 14, that is accounting for amalgamations. Last video, I have completed accounting standard 13, that is accounting for investment. Hope my regular viewers have already watched all the earlier videos on accounting standards. If you have not watched, I suggest you go to the playlist of my channel. Select the subject accounting standards. Watch all the videos on accounting standard and be perfect on the provisions, requirements of accounting standard. And this subject is very important not only for graduate students but also for postgraduate and professional students who are pursuing the CA courses or CMA or CS, etc. So give more concentration, watch with full concentration, definitely you'll get a good command on these accounting standards. Now before proceeding, take the screenshot of the points which I have written for accounting standard 14, AS 14, then I'll explain all the points in detail. Come on. AS 14, accounting for amalgamation. Actually, the general meaning of the term amalgamation is when two or more companies are merged together, combined together, it is called amalgamation. So there are different terms which are related to amalgamation like absorption or acquisition or merger like that. But there is small technical difference between these terms. Now first of all, we discuss about the meaning of the term amalgamation. Accounting standard AS 14 has not clearly given the meaning of the term amalgamation. It says amalgamation means amalgamation according to the provisions of the Companies Act 2013 or any other relevant statute relating to companies. So first of all, this AS 14 deals with accounting for amalgamation and the treatment of any resultant goodwill or capital reserve. That means whenever there is amalgamation, it will give rise to goodwill or capital reserve. So how to treat the goodwill or capital reserve, that is explained or dealt with this accounting standard AS 14. Now amalgamation means amalgamation pursuant to provisions of Companies Act 2013. So in India, the present law is Companies Act 2013. So Companies Act 2013 has given the meaning of the term amalgamation. So accordingly, AS 14 says amalgamation means whatever amalgamation pursuant to Companies Act 2013 or any other statute which may be applicable to companies. Not only Companies Act, but any other law which is related to companies that has given the term amalgamation, and that is the meaning of the term amalgamation according to AS 14. Now this standard is not applicable to acquisition, whereas one company acquires the whole or part of the shares or assets of another company for consideration. So this standard AS 14 is applicable only for amalgamation. It is not applicable for acquisition. In acquisition, one company will acquire a majority of shares or other assets of another company. That is called acquisition. For example, ABC company, XYZ company. ABC company has acquired 90% shares or 80% shares of XYZ company. It is called acquisition. It is not called amalgamation for the purpose of AS 14. Now, in case of acquisition, the acquired company is not dissolved and its separate legal entity continues to exist. Example, just now I have given the example, ABC company has acquired a majority of shares in XYZ company. So XYZ company is not dissolved. The separate legal status of XYZ company is still there. Only the majority of shares are acquired by ABC company. It is called acquisition. Then thus in order for this standard to apply, at least one company must cease to exist. So this AS14 says this standard will apply only if one of the company should cease to exist. That means one company should be completely dissolved. ABC company acquired XYZ company. After acquiring XYZ company should be completely dissolved. There should not be any legal status of XYZ company. Then only this standard will apply. Now the company which is amalgamated into another company is called the transferor company. So the terminology is given by AS14. Transferor company and transferee company. The company which is dissolved, the company which is absorbed by another company, that company which is finished is called transferor company. Example, just now I have given ABC company purchases the complete business of XYZ company. So XYZ company is called transferor company because XYZ company is finished. All the assets and liability of XYZ company are taken over by ABC company. So the selling company, the company which is wound up, is called transferor company. And the company which is purchasing the business is called transferee company. The company into which the transferor company is amalgamated is called the transferee company. So two companies we have. In simple language we can say purchasing company is the transferee company, and the vendor company, selling company, the company which is dissolved is called transferor company. Now types of amalgamation. AS14 has divided the amalgamation into two types. The first one, amalgamation in the nature of merger, and secondly, amalgamation in the nature of purchase. This is very important. In examination, you may get a question regarding explain the provisions of AS14, accounting for amalgamations. So whatever I am explaining, the same thing you have to write. So that's why I am stressing that not once but twice, thrice you watch this video. You will get the complete command, what are the things we have to remember and write in examination regarding this amalgamation. So two types of amalgamations, amalgamation in the nature of merger and amalgamation in the nature of purchase. So one by one we will discuss. First, amalgamation in the nature of merger, first type. And amalgamation is in the nature of merger if some 1, 2, 3, 4, 5. 5 conditions are given. If all these 5 conditions are satisfied, then only that amalgamation will be called as amalgamation in the nature of merger. If any one of these 5 conditions are not satisfied, then it will be called amalgamation in the nature of purchase. So here merger, amalgamation in the nature of merger, here amalgamation in the nature of purchase. If all the 5 conditions are satisfied, it is merger. If any one of the condition not satisfied, amalgamation in the nature of purchase. Now we'll discuss what are the 5 conditions. The first condition, all the assets and liabilities of the transferor company are taken over by the transferee company. First condition, all the assets and liabilities of the transferor company should be taken over by the transferee company. Example, ABC company is the transferee company, XYZ company is the transferor company. That means all the assets and liabilities of XYZ company should be taken over by the ABC company. If any asset or liability not taken over, then this condition is not satisfied. In that case, it is not amalgamation in the nature of merger, it is amalgamation in the nature of purchase. First condition, all the assets and liabilities should be taken over. Secondly, the shareholders holding at least 90% or more of equity shares of transferor company becomes equity shareholders of the transferee company. That means when the amalgamation will be called merger, if not less than 90%. That means 90% or more the shareholders of transferor company agree to become the shareholders of the transferee company. So before amalgamation, the transferor company has to convene a meeting and put the representation before the shareholders. If 90% or more of the shareholders agree to become the shareholders of the transferee company, then the amalgamation will be called merger. If less than 90% of shareholders agree to become shareholders of transferee company, then the condition is not satisfied. It is called amalgamation in the nature of purchase. So 90% or more shareholders must give a consent that they want to become the shareholder of transferee company. Third one, consideration for amalgamation is paid to equity shareholders of the transferor company in the form of equity shares of transferee company, except for fractional shares which can be paid in cash. Third condition, the purchase consideration payable by the transferee company to the transferor company should be in the form of shares. That means ABC company is acquiring the business of XYZ company. So ABC company has to pay the consideration. The consideration paid should be in the form of equity shares. Cash will be paid for fractional shares. If while calculating the purchase consideration fractional shares comes, then it will be paid in cash. But other than that, shares should be paid in the form of equity, in the form of PC to the transferor company. Next one, business of transferor company is intended to be carried forward by the transferee company. That means the business of the transferor company should not be dissolved. The same business of transferor company should be carried on by the transferee company. The business should not be changed. Example, before merger, before amalgamation, the transferor company, XYZ company, carries on, suppose, some fertilizer business. The same fertilizer business should be continued by ABC company. After acquiring XYZ company, ABC company should continue the business, should not change the business. Fourth condition. Last condition, no adjustment are made in the book values of assets and liability of the transferor company except to ensure uniformity of accounting policies. Another condition says the values of assets and liability of the transferor company, the same value of assets and liability should be recorded in the books of the transferee company. Example, the transferor company is XYZ company. In the books of XYZ company, all the assets and liabilities are valued. The same values should be taken by the transferee company. The values should not be changed, except where for the purpose of uniform accounting policy it has to be changed, then it can change. Suppose ABC company is following a particular accounting policy. In order to continue that accounting policy, it has changed the values. So it is permitted. It is allowed. But without that, the values of assets and liability of the transferor company should not be changed by the transferee company. The 5 conditions are over. If all the 5 conditions are satisfied, then it is called amalgamation in the nature of merger. Then what is amalgamation in the nature of purchase? If any one of the condition, if any or all of the conditions are not satisfied, then it is called amalgamation in the nature of purchase. Now, accounting, method of accounting. What is the difference in accounting method in case of amalgamation in the nature of merger and amalgamation in the nature of purchase? Definitely there is different method adopted for merger and purchase. So first of all, we'll discuss what is the method of accounting if the amalgamation is in the nature of merger. The method to be adopted is called pooling of interest method. So pooling of interest method is a method of accounting for amalgamation if the amalgamation is in the nature of merger, right? So in this method, while preparing the financial statements of transferee company, the assets, liabilities and reserves except share capital of the transferor company should be recorded at their existing carrying amounts and in the same form as at the date of balance sheet. Very important paragraph, this one. So while making the financial statements of the transferee company, in our example, the transferee company is ABC company. So while making the financial statement of ABC company should record all assets, liabilities and reserves of the transferor company at their book values only. So whatever the balance sheet values are there, same balance sheet values should be taken in the financial statements of the transferee company, right? Same carrying amount, same form. The difference between the purchase consideration, PC stands for purchase consideration. The difference between the purchase consideration paid by the transferee company and the share capital of the transferor company is adjusted with reserves. This is very, very important. The difference between the purchase consideration and the share capital of the transferor company. This difference should be adjusted in reserves. Example, ABC company has paid the purchase consideration 10 lakh rupees to XYZ company. This is the PC, 10 lakh rupees purchase consideration. Whereas the share capital of XYZ company is 8 lakh. So 10 lakh rupees purchase consideration, 8 lakh rupees is the share capital. The difference, 10 lakh minus 8 lakh, 2 lakh rupees is the difference. That 2 lakh rupees difference should be adjusted in reserves. The balance in profit and loss account of transferor company is aggregated with the P&L account of transferee company or transferred to general reserve. So whatever balance in profit and loss account of transferor company, that balance in P&L account will be added to the balance in P&L account of transferee company. Example, 2 lakh rupees is the reserves of transferee company and 1 lakh rupees are the P&L account balance in the transferor company. So whatever P&L account balance in transferor company 1 lakh, that will be added to the P&L account of the transferee company. Both the P&L account balance should be clubbed, added, right? Now, so this is the pooling of interest method. This pooling of interest method will be applied if the amalgamation is in the nature of merger. All the assets, liability and reserves will be taken in the same form, in the same amount in the financial statements of the transferee company, right? The difference between the purchase consideration and the share capital of transferor company, that will be adjusted in reserves. Now amalgamation in the nature of purchase. In this method, the assets, liabilities of the transferor company are recorded in the books of the transferee company at the value at which these assets and liability are taken over. Agreed value. That means if the amalgamation is in the nature of purchase, then assets and liability which are taken over by the transferee company should be recorded at their agreed values, in a book values or fair value. Book value or agreed value. Whatever is there, the same values should be recorded in the books of the transferee company. Whereas in the nature of merger, exactly same values, whatever is there in the balance sheet, same values should be recorded. Here, it may be same values or it may be different values. This could be either by carrying amount of these assets or their fair value. That means the value of assets and liability may be the book values or may be the fair value. Then fictitious assets and reserves are not included. Here, in case of amalgamation in the nature of merger, the reserves will also be taken over. The reserves will also be included. But here in this case, amalgamation in the nature of purchase, the reserves of the transferor company are not recorded. Fictitious assets are not recorded. If purchase consideration is more than the net assets, the difference is debited to goodwill account. Now we compare the purchase consideration with the net assets of the transferor company. The purchase consideration paid by ABC company is 10 lakh and the net assets of the transferee company XYZ company is 8 lakh. So 10 lakh rupees purchase consideration, 8 lakh rupees are the net assets. The difference 2 lakh rupees will be debited to goodwill account. If the purchase consideration is less than the net assets, the difference will be transferred to capital reserve. Example, the purchase consideration paid is 8 lakh, whereas the net assets of the transferor company is 10 lakh. The business value is 10 lakh, but the amount paid by the transferee company is 8 lakh. The difference of 2 lakh will be transferred to capital reserve. Simply remember, if purchase consideration is more, the difference is transferred to goodwill. If purchase consideration is less, then the difference will be transferred to capital reserve. So we have to compare the purchase consideration with the net assets of the transferor company. That's it. This is the accounting treatment for amalgamation in the nature of purchase. Now, statutory reserve. The reserve which are compulsorily to be maintained. The reserve which are compulsory to be maintained according to statute or according to law for a particular period of time. That is called statutory reserve. So SR, statutory reserve are the reserve that are created as per statute or law. Usually there is some restriction on utilization and maintenance of such reserve for a particular period. The law, the statute will say that this type of reserve must be created, must be maintained and utilized for a particular period. For example, investment adjustment reserve. The law says investment adjustment reserve should be maintained for a period of 5 years. That means this reserve is compulsorily applied by law. It is called statutory reserve. It should be created for a particular purpose and it should be utilized during a particular period. Now, in case of amalgamation in the nature of merger, no separate accounting adjustment is required for statutory reserve. It is recorded in the transferee books along with other assets, liability and reserves. If there is any statutory reserve required, no separate accounting adjustment is required if the amalgamation is in the nature of merger. Because in the case of amalgamation in the nature of merger, all the assets, liabilities, reserves are taken over. So no separate adjustment is required for statutory reserve. But if the amalgamation is in the nature of purchase, then the reserves are not taken over. If the amalgamation is in the nature of purchase, the reserves of transferor company is not taken over. In that case, if statutory reserve is there, what is the accounting treatment? Here it is given. So in case of amalgamation in the nature of purchase, the transferee company needs to record the statutory reserve in its books. This is done by debiting a new account called Amalgamation Adjustment Reserve and crediting to statutory reserve. An entry should be passed. Amalgamation Adjustment Reserve debit, statutory reserve credit. Statutory reserve should be created. A new account called Amalgamation Adjustment account should be debited. By passing this entry, we are recording the statutory reserve in the books of the transferee company. Right? Amalgamation Adjustment Reserve is disclosed as negative reserve under reserves and surplus. Now, where should this Amalgamation Adjustment Reserve should be shown? Actually, it is showing a debit balance. It should have been taken on the asset side, but it is not correct to take it on the asset side. So we are taking this amalgamation adjustment account as a negative figure under reserves and surplus. That is the accounting treatment for statutory reserve if the amalgamation is in the nature of purchase. Now, goodwill. Actually, goodwill will arise if the amalgamation is in the nature of purchase. When the goodwill will arise, if the purchase consideration paid is more than the net assets of the transferor company. So goodwill arising on account of PC being more than the net asset should be treated as an asset, which is to be amortized on a systematic basis over its useful life. So what this AS14 says, if the goodwill is arising on account of amalgamation, it should be treated as an asset and it should be written off or amortized over a period of time. It is considered appropriate to amortize goodwill over a period not exceeding 5 years. So normally there is a rule that this goodwill should be amortized over a period of 5 years, not more than 5 years. But unless such longer period can be justified. If a longer period is justified, then it can be amortized for a longer period. But normally it will be amortized within a period of 5 years. So these are the points you have to remember regarding this AS14 accounting for amalgamations. Now, the disclosure required for AS14 accounting for amalgamation. The disclosure requirement is, first of all, in the first financial statement of transferee company, the following disclosure of all amalgamations should be made. The first time when financial statements of transferee company is made, the following are some of the disclosures required as per AS14. The first thing is the names and general nature of business of each of the amalgamating companies. The first financial statement of the transferee company, they should list out the names and the nature of the business of each of the transferor companies. Secondly, effective date of amalgamation. What is the effective date of amalgamation? The method of accounting used and particulars of the scheme sanctioned under a statute. If particular scheme of amalgamation is given as per the statute, that should be disclosed. And for amalgamation in the nature of merger, now we have to see whether the amalgamation is in the nature of merger or in the nature of purchase. If the amalgamation is in the nature of merger, the disclosure requirement is description and number of shares issued. So how many shares are issued by the transferee company to the transferor company? Secondly, the amount of any difference between the consideration and the value of net identifiable assets acquired. So the company, the transferee company must disclose the difference between the consideration paid and the net identified value of assets. The difference they have to explain. Then for amalgamation in the nature of purchase, if the amalgamation is in the nature of purchase, then the disclosure requirement is consideration for the amalgamation and the description of the consideration paid. In the case of amalgamation in the nature of merger, the consideration will be paid only in terms of shares. So here shares are given. But in case of amalgamation in the nature of purchase, the consideration may be paid in shares or may be paid in cash. So a description is required. What are the different forms of payment of purchase consideration? Secondly, the amount of difference between the consideration paid and the value of net identifiable assets acquired. That means if the amalgamation is in the nature of purchase, how much PC is paid and how much is the net assets value? If the PC paid is more than the net assets value, goodwill will be debited. If the PC paid, purchase consideration paid is less than the net assets value, then the difference will be credited to capital reserve account. So the company has to explain, disclose how much is the difference, whether it is goodwill or capital reserve. Then the period of amortization of goodwill, if any, arising from amalgamation. If on account of amalgamation goodwill is arising, then how many years we are going to write off the goodwill? That disclosure should also be made. So these are the disclosure requirement. So in this video I have explained in detail regarding AS14, accounting for amalgamations. Inshallah, the next accounting standard will take up in the next video.